If there's no shares available to actually do this, then the brokers are on the hook to deliver it at whatever the market cost is. So whatever happens, no matter what AMC is trading for, no matter what APE is trading for, the brokers are going to have to deliver on every single share that the shareholders are entitled to of APE. Hello everybody, my name is True Demon and I'm the Devil's Stockbroker. In this video, what you're going to see is a short clip that I did while I was doing a stream on Friday as we were watching AMC absolutely ripping shorts faces off. It was a hell of a stream. We really enjoyed, but this particular question got asked in regards to how the APE equity dividend worked, and I was asked to explain it, at least to the best of my abilities. And some really good information came out of that, so I wanted to share that with you in a separate video and hopefully explain the way that this dividend works, what it means for retail AMC shareholders, and why this is a very good, very bullish action taken by the AMC leadership, and how this is going to work in the favor of AMC going forward as it works its way out of this this pandemic and continues to prove that movie theaters are here to stay and that AMC is going to be the king of the retail movie theater chain. Oh man, AMC is just absolutely skyrocketing. Those shorts do not want to pay that goddamn dividend. I promise you that. That is what's going on right now. Nobody wants to be paying that equity dividend because it's
Can
so
you explain
yeah.
that?
Yeah, absolutely. Okay, so let's go ahead and go into what is going on with the AMC dividend, all right? So a lot of people are very confused about what's going on with the dividend versus like the GME split, and like it's some people are saying it's just like the BBIG Cryptide spinoff dividend. It's its own thing, okay? So AMC has currently it has one equity, right? So AMC has Class A common stock, all right? This is your AMC shares, all right? And that's what the Class A common stock is. Now, over here, we're about to go ahead and create a new equity called APE. That stands for AMC Preferred Equity. Now, what AMC Preferred Equity actually is a preferred stock. That is a preferential stock which kind of acts as a secondary equity for the company. Now, the thing is that these two equities are totally separate. They have their own price. AMC is currently trading at $22.40, and what APE is going to be trading at when it opens on the market is 1 penny. However, because these are separate equities, once APE goes onto the open market, and every single one of these shares are going to existing shareholders. So for every share, this is a 1-to-1 dividend. This is a 1-to-1 dividend. So this 1-to-1 dividend means that for every share of AMC, you are gifted. This is a gift from Adam Aaron to every single one of the apes. 1 share of APE. Now, you might look at this and say, like, big fucking deal, demonetized. I'm only getting one. I'm only getting 1 cent.
I told you.
Quiet. I don't want to hear it. All right. So you might be thinking, big deal, I'm only getting a share that's worth 1 cent. Well, here's the thing. Apes are going to go onto the market at 1 cent because that's the par value of the stock, but that's not what it's going to be trading at. See, you are going to be the only holders of this equity. When this goes out, it's only being issued through a dividend. They're not issuing any additional stock, at least not right away. So because of that, APE is going to trade at whatever the market decides it's going to trade at. So all of a sudden, if you have a situation where all equity holders of APE turn out to be retail shareholders, you can dictate whatever price you want. If you want to if you want to set a limit order for $10,000, just throwing out a ridiculous number, by the way. I'm not saying this is what's going to happen, but like say you put a limit sell for $10,000, and if somebody buys that, then that's what the price is going to be. If somebody is willing to pay that money for it, that's what the price is. If you really believe that the AMC apes are the ones that own all of the stock, then you're the only ones who are going to get this equity. You dictate what the price is. You get to decide what you're willing to sell it for. If that's what happens, then you decide what the price is. And whoever's willing to buy it at that price, they dictate what the market price is. That's the traded market value. So the chances that APE stays at 1 cent, extremely unlikely. It's just not going to stay at 1 cent. But that's the issuance cost for AMC to actually generate this equity. So as a result, AMC is they're paying 1 cent per share of AMC in order to create an equal share of APE. And this is what it will cost AMC in order to generate that equity. And you are welcome to pay whatever you want to get more of it. Now, here's the other thing, is that because you're getting this equity and it's going to be delivered to you at cost for AMC, AMC is going to be paying 1 cent to you in order to be entitled to that, all right? However, you're also, if you're in the camp that says that there's naked shorts, and you could say like it's you could say that it's 1 billion naked shorts or whatever. You can say whatever you want. We don't actually know how many naked shorts there are. There's no way for us to know, but let's just pretend that there's like 1 billion. So that would be 3 times AMC's float, right? So there's 1 billion naked shorts. You add on the 500 million plus change shares that are out there. Guess what? Everybody who owns an AMC share, whether it is an IOU or a synthetic share or not, they're entitled to this dividend. They're entitled to receive these. So this is where the shorts and brokers get into big fucking trouble. The shorts only have to pay the money, the cash in lieu of a dividend in order to maintain their position. So the shorts only have to pay a cent, but that's not who really gets fucked in this situation. The one who's screwed is actually the broker. So the broker is the one who lends out all the shares. So that means that the broker is on the hook for all of these shares to be delivered to everyone who's entitled to APE or the Class B stock. So because of that, the broker now needs to satisfy that settlement. The broker needs to actually put 1 APE in each person's account for every share of AMC they hold. And if APE if there's no shares available to actually do this, then the brokers are on the hook to deliver it at whatever the market cost is. So whatever happens, no matter what AMC is trading for, no matter what APE is trading for, the brokers are going to have to deliver on every single share that the shareholders are entitled to of APE. So if there's 1 billion naked shares, then they need to deliver 1 billion shares of APE, regardless of whether they have any in their account. Now, you can hypothesize that brokers are able to do this. You can just say, oh, well, they'll just generate more naked shares. But here's the thing. That's a liability on the broker's books. They still have to document this, okay? So these are still a liability. Naked shorts equals a liability. And in order to offset your liability, you need to have collateral. So what is collateral? Collateral can be a few things. Collateral can be the shares themselves. You can actually hold shares and they can act as collateral. You can hold other things such as alternative equity, such as shares of another stock. This is the same concept as when you hold margin in your account, and your margin is determined by the equity value of your total stock that you have in your portfolio, and the margin is the cash value that you can trade loaned against and collateralized against the equity of your account. But how brokers do it, they tend to actually buy something very specific. It's called T-bills. These are treasuries. Treasuries that are backed by the federal government. Treasuries specifically that are less than 1 year to maturity. Their favorite type are 6-month T-bills. This is the collateral that brokers need to have on their books in order to make sure that they have collateral against all of the loaned out shares that they have. If they're lending out shares, they need to have collateral to serve in case they need to deliver monetary value. If for whatever reason they must be forced to deliver, they need to have enough T-bills or some other form of collateral in order to cover their costs. So that's what's going on right now. Brokers are either unable to get this collateral because right now there's a shortage of T-bills in the market. As of late, T-bills have become more and more expensive. Recently, the yields have been going up, which indicates that there's a lot of selling of T-bills going on in the market, but that's not what's important here. The important thing is that the collateral needs to actually be something that holds value, and that's going to get expensive for the brokers. If they're not generating any money off of this, which they are not because this is an equity dividend that's being gifted by the company, then the brokers need to come up with this liability collateral. They need to come up with the collateral to match this liability. Otherwise, they are essentially in default. If their books are not balanced, then they will be forced to either buy back shares of this, or they will need to cover forcefully. They will need to force their short sellers to cover their position by recalling shares. So these are the possible scenarios that can play out as a result of this occurrence. What Adam Aron has done is basically put the screws to the broker. Adam Aron has basically issued an ultimatum to brokers to put their money where their mouth is. If there are actually that many shares of AMC and you are 100% certain that you have only lent out the appropriate number of shares and there is no counterfeiting going on in this stock, then prove it. You will issue 1 share of APE, a secondary equity, to every single share out there on AMC. And what you are seeing in the price action right now is serving as evidence, not proof, but evidence that they do not, in fact, have that equity. They do not have that collateral, and they do not have any way of actually delivering the appropriate amount of shares to sellers. Now, retail could be driving a good bit of this volume, but what I suspect you'll find is that as brokers they slowly come to realize just how much liability in the form of naked shorts they have on their books, they will be forced to get rid of that liability and offset their risk, either by buying more collateral, which is going to cost them money in a market which is already experiencing a massive shortage of T-bills and collateral. This is a thing that's really going on. If you want to look it up, there's plenty of other YouTubers that are describing it, and I'll try to do a video on this at a later time. But there is a collateral shortage going on right now due to things like rehypothecation of shares. This has been going on for quite some time, and it's an ongoing problem in the market. I'll try to do a better job of explaining this in a future video, but that's all I've got for now. So thank you for watching. Have a hell of a time in the markets.